That's good. So increasing term is return of premium term. All righty. There's a function for increasing term. All right, now let's do decreasing term. Decreasing term is for credit life. See that? So what decreases? The face amount. So the increasing term face amount increases. On decreasing term, the face amount decreases all the way to zero by the last year. Got it?
Then decreasing term, you can choose to what age you want it,
Yeah,
or
you
you can
could.
go up to
What's up?
100.
No, no, no. Term insurance is for a certain period of time. It never goes to age 100. So term
Oh, okay.
insurance does not go to age 100. Okay? Term insurance ends before age 100. The only thing that goes to age 100 is what? Genesis.
Whole.
Whole life. Yes. Okay, so that's good. So this could be a time frame. You see that? The time frame right here?
Mhm.
Okay, look. Time frame, it could be a 30-year term, a 20-year term, a 10-year term. That's the time frame. Got it?
Yes.
Yeah, this is good stuff right here. Undo, redo. Okay. Okay, so what is credit life? Let's talk about credit life. What is credit life?
Usually used for people who want to pay off their debt.
Yes, there you go. So that's why so let's say right here they got a policy that covers them for they borrowed $30,000, let's say.
Mhm.
When the term is over is when they should have paid off their loan, so now they don't need that much coverage because they don't owe any money. All right,
Okay,
but
and then with the decreasing term for credit life, they can renew the term.
that's not gonna be on the test. You don't, decreasing any term, okay? On the test, they want to know that you know this. Any term insurance, you could do two things when the term ends. Okay, you could renew it or you could convert it. Okay, tell me what you know about renewing it.
When you renew it, you don't have to show your proof of health.
Yes, insurability. And the test they use the word insurability. Um, yeah, so you could renew it. Is the price gonna go up, down, the same?
It stays the same by the age.
No,
Or that's a rider, right?
yeah, when you renew it, it goes up. The cost goes up because you're
Mhm.
older. Okay, the one you're talking about is a guaranteed insurability rider. The guaranteed insurability rider is a whole different topic. Okay, so don't confuse them. When you renew it, it goes up. Always. Always roll? Yes, always. It goes up. The price goes up because you're older. But you don't need to show that you're healthy. In the test, the wording is this. You don't need to prove insurability. No evidence of insurability is required. That's what they use on the test, okay? Now, what happens when you convert it? Do you have to show insurability as well?
You do, but
No, when you convert it, you don't show insurability, but it's going to be converted to a what?
do a whole policy.
Yep, whole life. Okay. You're converting it to a whole life and you don't have to show insurability either. So you don't show insurability on either or. Okay. On the test. That's test world. Got it?
Yes.
Any questions on this?
No.
All right, let's go back to this. Now, what's the other type of term? There's level term.
Um,
This one's
level.
easy. Everything stays level for the for the term. 30-year term, 20-year term, or 10-year term. Everything stays leveled. That one's easy. That's the
But
most basic form of term.
so, okay, but my question is on the level term. At
Yep.
the end of it, it's still like there's no cash value either. Like it just cancels.
Well, no, remember, when the term ends, you could do two things: renew it or convert it. Remember that, okay?
Okay, yeah.
And yes, term insurance does not have cash value, period.
Okay.
All right, let's go to annual renewable term. Annual renewable term. This is the insurance component of universal life policies. Universal life insurance component is annual renewable term. How does it work? In this policies, the face amount stays the same, but the premiums go up every year, annually. Annual renewable term. It's in the word, right? So the cost goes up every year. Any questions?
No, I think we went over that
All
last
right,
time.
cool. Perfect, perfect, perfect. And here's a visual of universal life. See the annual renewable term part of it? Cash
Hmm.
value grows, but then it drops because the cost of insurance is more than your monthly payment, your premium payment. You see where the cost of insurance became higher than the green line. The red line becomes higher than the green line, so the cash value starts going down on that point. Flexible premium adjustable life. You got to remember this too. Universal life is also known as flexible premium adjustable life. Okay. Annual renewable term insurance, cost of insurance, and there's a surrender charge. Remember what a surrender charge is?
That's if you want to drop the policy limit,
Yep.
the new. Or-
Yeah, if you want to cancel your policy or surrender your policy or drop your policy, but in the test they use the word surrender, okay? If you want to surrender your policy, then you're gonna if you cancel it early, if you surrender it early, there's gonna be a fee, and that fee is gonna eat up your cash value. So in the beginning part of these policies, there's no cash value because of the surrender charge. And whole life works like this. It starts with zero cash value, and at age 100, it matures or endows is the same word, okay? They use in the test they use them interchangeably. Matures or endows, okay? And it equals the face amount at age 100. So at age 100, you get the face amount. And the policy cancels after age 100. But it also has a surrender charge in the early years. Got it? Any questions on whole life?
Question on, because I know there's three types of under whole life, the permanent.
Yeah.
The one I
Ho-
was the one I was confused on was the straight life, ordinary life, because I kept getting that one a lot on the test. And then there was like a few scenarios where I was just like, I was a
straight
bit
life.
confused.
Straight
Yeah,
life is also known as whole life. So don't get it confused.
it's just the
They
same thing.
is the same thing. They're just trying to mess with you.
Okay,
It's annoying. I know. It's annoying. Same thing as this, like matures and endows. Those are two words that they use in the test interchangeably, but it's the same damn thing.
okay.
So straight life, whole life, same thing. When you hear the word paid up, that means, see, I should add the word here too. Let me add it right now because matures, endows, and also paid up. All these three things mean the same thing. Paid up, matures, endows. Okay. Okay. Where were we talking about right now? That we were going to get into it? Non-forfeiture options. Remember that? Non-forfeiture options, a scenario is the guy was paying 300 bucks a month, but he's broke. He can no longer make a monthly payment. So he tells the company, "Hey, I don't want to lose my policy." And the insurance company says, "No problem. You got $15,000 in cash value in your policy. We could use this money." Okay. So we're going to use this money. Okay. We're going to use this money. All right. We're going to use it to either, you could, number one, cash out, ¿verdad? Just take your money. Another thing you could use it for is we could use it to, um, it's called extended term non-forfeiture option. So this one, let's say the client had $300,000 in coverage, okay? Face amount. Extended term works like this. Extended term, the client's going to keep the $300,000 in coverage, but now it's going to go to term insurance. So it's going to end soon. It doesn't go to age 100, but it keeps the same coverage. And then number three, the third option that you could have is called reduced paid up. Reduced paid up. What does that mean? That means that the face amount is going to be reduced. So I'm going to reduce it. So it's going to be reduced to, let's say, I don't know, 100,000. But it's going to be paid up, which means what? Which means endowed, which means matured to age 100. There it is. Pretty simple stuff right there. You got it?
Yeah. I know for the extended term, um, oh wait, never mind. It was a different one. Because I know
Yeah.
on one of the policies, you can use like one of your like your dividends. Yeah, it was dividends. I'll
Yeah,
get
so
it.
this is non-forfeiture options. The other one is dividend options. Okay, dividend options is, hey, your policy is going to give you a dividend. How would you like to get your dividends? One of them is cash out, ¿verdad?
Yes.
Just give me my money. Number two is reduce, reduction, reduction of premiums. Number three is interest only. So basically they put the dividends into a place and they get interest. Number four is paid up additions. So that means you're gonna get whatever it buys for whole life insurance, right? So give me
Mhm.
coverage that's paid up to age 100. And then number five is 1 year term, which is what it means, what it says, right? So use these dividends to give me a 1 year insurance, 1 year term insurance. How much can I buy with 1 year for 1 year with this dividend? Got it? Also, are dividends guaranteed? Dividends are not guaranteed. What kind of companies pay dividends?
Uh,
What is the name?
mutual mutual companies?
Yep, mutual companies. Like Mutual of Omaha, New York Life, Northwestern Mutual. Are dividends guaranteed? No, ¿verdad?
No.
You might not get it. What is a dividend? What is a dividend?
It's the extra premium that you pay, and
It's
it's
an
just your return.
it's a return of overpayment of premiums. Okay? You got to get it right. The wording right. It's an
Over
overpayment of premiums.
premium.
Okay? So that's let me see what else. You know what? I should share this. This is really good. I'm going through some good stuff right here. I'm gonna share it on my chat. There's a chat for on Telegram for
Mm.
just life licensing, and what I do is I post up different things, but I'm live. Jump in to study with me. So, are you part of this chat? If you're not part of this chat, let me know so I could add you to this chat, and that way you could jump in on a meeting when I'm doing a live meeting like this. All right. So, mutual companies. What kind of policies pay dividends? Good question. What kind of policies pay dividends? Remember? What are they called?
Participating.
Dang, girl. Come on. You're going to pass it the next time. Yep. Par. Come on, man. This thing is not working. What's going on with this? Participating. No, not companies. Policies. Participating policies pay dividends. That's it. That's all you need to know about dividends. So you got dividend options. You got um, non-forfeiture options. I'm gonna put it here. Non-forfeiture options. And then there's a third one. There's a third one called settlement options. What is settlement options? Give me a scenario. What's the scenario of settlement options?
That's how you want to claim your money.
Yep. Dude, Genesis, you're gonna pass this test, dude. You know what's kicking your butt? I know what it is. It's not this right here. It's the Texas laws and regulations. That's what's kicking your butt, to be
Yeah.
honest. It's not this because you know your stuff. You know your stuff. You should in California you would pass it because California has like very little California laws and regulations. But Texas, for whatever reason, they want you to know their laws. So
I like more than half of the test for the.
yeah, I think it's 50-50. Yeah, it's crazy. So settlement options, the scenario is this. Mr. and Mrs. Klein, if you die, how would you like your wife to get that money? And then you choose the settlement options.
I think where I get confused is whenever they talk about like all of these options, and I'm just like, okay, well then which one comes into the policies, like, you know?
In terms of settlement options?
Like, because they ask me, so when it asks me about a policy. Like it says, okay, they have a whole life policy, but they want to cash or they want to cancel the policy, and then it says like which option would they choose? It's either the non-forfeiture, the settlement, or then it says a random policy, like just a random
Like a
one
random.
that's obviously, yeah, one that's
Yeah.
obviously not in the picture.
Yeah. So just remember the scenarios, Genesis. A settlement option is, hey, Mr. and Mrs. Klein, how would you like your money when you do get it out? That's the settlement option. Non-forfeiture option is, bro, I'm broke. I cannot make my payments anymore, and I do not want to forfeit my policy. So what are you gonna give them? Non-forfeiture options.
Okay, so then the settlement option is just whenever their policy's done.
Yeah, it also applies to annuities. So
Mhm.
annuities is, hey, you retired already. How would you like your money? In other words, they're asking them, what settlement option do you want?
Okay,
Okay. So just think of the scenario and that settlement option, or it's dividend option, or it's non-forfeiture option. You got to think of the scenario of the
okay,
client. Because that one I think you got it right because I'm asking you what is a scenario and you're telling me. So I think you got that one right. You understand the
Yeah.
scenarios here. Okay.
It's just when it comes to the question and it asks me which settlement option or non-forfeiture option, and then it's just like whole life policy, and I'm like, obviously not that one. But then it comes to these two, and I'm like, I forgot like which one
Yeah.
would apply.
How about this one? Okay, let's look into this. There's settlement option is um fixed period. Okay, fixed period. Period means a time frame, right?
Mhm.
So tell me how that one works.
Fixed period meaning you have this amount of money, and then you just want to use a period of time to get that money, basically. So it's just like a little bit of money within this time frame.
Yeah, so the client says, "I want my money. I don't care how much per month you give me, as long as it lasts me X number of years, like let's say 20 years." That's fixed period. So the client says, "I want my money for 10 years. I want my money for 30 years. I want my money for 50 years." That's called a fixed period. What if the client chooses fixed amount? Fixed amount. That's when the client says, "Hey, I want my money. I want my money monthly. I want X dollars per month." So let's say how do I want my money? I want to get 7,000 a month until the money runs out. So what settlement option are they choosing? Fixed amount. Okay. Another one is joint joint life is a settlement option. That means it's covering two or more people and I want money until one of us dies, the survivor gets the money. That's called joint life. Number four is joint and survivor. Joint and survivor, it covers two or more people, but it only pays until the last one dies. You with me?
Yeah.
Number five, there's a lot of them. Life only, or is also known as pure life. Pure life settlement option. That means give me money until I die. I don't care what happens after that. Just pay me while I'm alive. And when I die, that's it. You could do whatever you want with it. Um, what if the insurance company runs out of money? Does it still pay? Yes. It pays even if there's no more money left over. That's why people like that one because it also gives the biggest premium out of all of them.
Okay, so for those two, the joint life and the joint and survivor, those automatically come with those, like the settlement options.
It's one of yeah, some of the settlement options.
Okay. Because I was thinking that for the joint life and the joint survivor, a settlement option was a rider. Like you had to purchase like as I don't know
No.
why.
No, riders are a whole different ball game, okay? This is how do you want your money right here. How do you want your money? Settlement options is how do you want your money? That's after the fact. Once the money's saved up, once the person dies, how do you want your money? Riders is remember I told you last time, right? It's a sweetener to the black coffee. It's a sweetener so that the coffee tastes better. So it's more attractive. It makes the policy more attractive. A rider makes the policy more attractive, but it costs money, but it makes it better. Like waiver of premium it's a rider. You know, child rider, it covers the kids, that's a rider. Um, automatic premium loan rider. All those things are riders. Those
That
are
was another one I wanted to go over, the waiver premium.
yeah, let's do it. So let's talk about it. Oops. So waiver premium. So it's waiver of premium.
And that one you can add it to any policy, right? As a writer.
Well, this is for adults because if let's say me, I buy a policy for my daughter, the waiver of premium is not called waiver of premium, it's called payer benefit rider, which works the same way. These two work the same way, but this is for a minor. Got it?
Yeah.
So how does this work? This waives a premium for as long as I'm on what? So this is a disability thing. Disability. The disability has to be for 6 months. Okay?
Mhm.
You got it?
Yeah.
So that's a waiver premium rider. It pays the premiums for as long as you're disabled. So you basically have free insurance for as long as you're on disability. But the disability has to be for 6 months. So there's a waiting period of 6 months. That's a rider. Okay. Royalty. Hopefully you're learning. I know you just jumped in. Thanks for joining us.
Yes.
And hope you're learning something. This is good. All this stuff is going to be on the test wherever you're at. This is in every state of the United States. Every state has the same
I'm
stuff.
in Tallahassee, Florida.
Okay. Yep. Yeah, Florida is a lot like Texas. Florida is 50-50. So 50% of your exam is um is all laws and regulations, and the other 50% is this stuff right here that I'm teaching. Yeah, so just take notes. I'm recording these calls anyways, so I'm gonna post them up on my YouTube channel. Everything's on the YouTube channel.
Okay.
And for those of you listening to the YouTube, if you want to be part of these classes, I put them on Telegram. So hit me up, fill up the form on the description of this video so that you could get the link to the Telegram so you could be part of it. And whenever I'm doing these lives, then you could just jump in. And also give you a bunch of free stuff that is not public on YouTube for free. Free 99. All right. So what else? Give me some more Genesis. Come on. What else did you did what else got you on the test?
The provisions.
Provisions?
Yes, that just that whole I think whenever I look back on like my like how I did on the like each of the chapters, the one I struggled the most was provisions, riders, and exclusions. Exclusions a lot.
Okay,
Provisions and exclusions.
provisions is more like rules, but let's go to exclusions, okay? Exclusions is easy. I'm gonna explain it to you. Exclusions. Exclusions is basically just think of the word wash. Okay. So wash, W stands for war. So if you die by war, then it's excluded. It's not going to pay. That means it's not going to pay. Exclusion means it's not going to pay. A is for aviation. That means if you die in a plane crash, it's not going to cover. S is suicide.
That was one of the questions too. It was asking me, it said, so which between they had committed suicide basically, so it was only between 2 years. And I think it's because in Texas, it asked me, it said that Esk had a policy, but of course the exclusion was he had committed suicide, and then it said between which months. Oh.
Yeah, so basically they're asking you for the 2 year contestability period. So there's a 2 year incontestability means that within the first 2 years, they have a right to check for fraud or suicide. But outside of 2 years, if the client dies after paying the policy for 2 years, then they're covered 100%, no matter
So
what.
meaning they committed suicide and then it's already been 2 years, so they have to pay the death benefit or the
Yep,
face amount.
yep. Even if it's been 2 years. Yeah. And then the last one is H, which is hazardous sport. Hazardous, I think they have it as hobbies or occupation, hazardous occupation. You got it? Okay, that's good. So again, exclusions basically is saying, hey, look, we're not gonna pay if you die this way. If you die by war, if you die by flight, if you die by suicide, if you die by hazardous sport or hazard, we're not going to pay, okay? So better not die that way. Exclusions. Simple, right?
Yeah. Another one that it had asked me on the test, like a question, it was basically saying that they had it's one of the I have it right here. It's on the settlement options. So going back to the settlement options, it said if a settlement option is not chosen by the policy owner or the beneficiary, which option will be used?
Cash, cash out.
So,
So the default settlement option is cash out.
okay.
That's a good one. Yeah, that one's like if they don't choose a settlement option, then the default option is cash out. 100% lump
Would
sum.
the beneficiary still receive it?
Yeah. Yeah, they still receive
Okay.
it because it's their money, but they're going
It
to
was
receive it in lump sum cash out.
okay.
Wherever premium, 6 months, is a disability rider, settlement options, non-forfeiture options, dividend options from mutual companies, participating companies.
Another one I was wanting to go over was the Graham-Leach-Bliley Act.
Graham Leach Bliliac. Let's go over here.
I,
Graham Leach Bliley. I don't even know if that's how you spell it.
no, it's Gramm.
That's okay. ChatGPT, my buddy
Graham.
Chad, my buddy Chad is gonna get it right. Watch. There it is. You see that? Graham Leach Bliley Act. He could read my mind. He knows what I'm talking about. It's my friend Chad. He's the man. All right, Chad. Graham Leach Bliley Act, the GLBA 1999, also called as the Financial Service Modernization Act of 1999. It says the purpose of it is all allows banks, insurance companies, and securities firms to consolidate and affiliate, removes barriers so one company can offer bank securities or insurance services. So one company can offer it protects consumers' professional financial information. That's the one right there. It protects consumers' financial information. Can you see my mouse pointer? You can see my mouse pointer on the screen or no? I'm moving it in front of the screen. Mouse, mouse, mouse.
I mean on your
I'm pointing at consumer personal financial information. You don't see?
No.
No? Okay.
no,
That's okay. It's because I'm pointing with my computer mouse, but anyways. Three key parts for the GLBA, financial privacy rules. So it protects financial privacy. Okay. So it allows customers to opt out the right to opt out. It safeguards rules, requires companies to protect security and confidential consumer information. See that? So you get the idea in Texas exam pointers. Oh, dang. You see that? Shoo. Sorry, Florida, but this is a Texas exam thing. Um, the exam often asks, what does it regulate? This is Florida too, actually. Correct answer, the privacy of consumer financial information. I would, if I was studying, guys, you're listening to the replay right here, I would use Chad all day long. I would use them in form of conversation mode, like right here, conversation mode. See if we could use them while I'm on Zoom. Hey, tell me more about the Graham Leach Bliley Act.
Absolutely. Let's dive a bit deeper into the Graham-Leach-Bliley Act, GLBA. So the GLBA is all about how financial institutions, which includes insurance companies,
Hey,
handle.
hold on. Put it in simple, super simple fourth grade terms.
Absolutely. Let me make it super simple, fourth grade style. So the Graham-Leach-Bliley Act is basically a rule that says if a bank or an insurance company has your personal money information, they have to keep it safe. They also have to tell you how they're going to use that info and let you say no if you don't want them to share it. Basically, it's like a rule that makes sure they have to keep your secrets safe and he'd be honest with you about it.
Bam. Does that clear it up or
So
what?
basically like HIPAA.
Like, yeah, kind of like HIPAA. Yep. Yeah, HIPAA has other purposes, but and yeah, that's on the test too, actually. HIPAA's on the test.
Another one too that would come up a lot was the FINRA, the FINRA, right? FINRA.
FINRA. Yeah, FINRA is a regulatory FINRA. FINRA is a regulatory. This one, what they do is they help you get they do a lot of things, right? So they regulate the securities industry, but it's to give you an exam on getting your securities license. Your securities license. Okay, so securities license. Why would you need your securities license to sell mutual funds? To sell stocks, right? To sell variable products like variable annuities, variable universal life, anything that has the word variable is a variable product. And you need a securities license to get it. And who regulates the securities business you write and the securities license that you need to get? FINRA. Good question. Variable products. These are variable products too. So in the test, anything that has the word variable is risky and you need an extra license called a securities license and you get it through FINRA. Good question. So if it doesn't have the word variable, then you don't need a securities license. Like for example, index universal life. Does it need a securities license? No, because it doesn't have the word variable. You need the word variable in there. So index universal life, you do not need your securities license.
That's the S&P 500.
The index means that it's tied to the S&P 500, which is the stock market basically. But it doesn't have the word variable, so you do not need a securities license. That's the key phrase right there. So permanent, right here, I have it write down. Permanent is like whole life or universal life or variable, anything that has the word universal life. versus term insurance. Term is temporary, like annual renewable term, increasing term, decreasing term, level term. We went over that already.
Two was the NAIC. I would get that one a lot.
Yeah, the NAIC is like FINRA. The NAIC is a regulatory and examination company that takes care of the life insurance exam, the insurance exam,
Mhm.
and FINRA is for securities license.
Okay. Mm,
But let's I think we're done. Does your brain
yeah.
hurt a little?
I think that was pretty much it.
Oh man. NAIC. Let's just do this real quick. National Association of Insurance Commissioners. What is it? Organizations of all 50 states. It's not a government agency, but a standards and model laws and states often adopt. It was founded in blah, blah, blah. What does it do? It creates model laws and regulations. There it is. It's all for insurance, protects insurance, oversees the insurance industry, the insurance companies, protects policyholders. It adopts states for licensing exams, coordinates across states. There it is. Question you're going to ask is, what is the purpose of the NAIC? Correct answer: to promote, uniform, and protect policyholders through model laws and regulations. Got it. Does NAIC make laws? Answer is no. The state must adopt them individually. See that? All right. I think we're good to go. But if you have any questions, hit me up, okay? You could screenshot whatever questions, send it to me by text. I'll help you. You're going to be
Okay.
one of our top agents. We're going to help you after this. We're going to show you how to make some money big time. All right. So stay focused. You should be taking your test pretty soon.